Okay, so let's talk a little bit about where we are in the market year to date. As you can see, the S&P through the middle of September is actually up for the year 18.1%. And the bond market, which I had talked about last month, has made a recovery. It had been down for years and actually was still negative going into this year, but has started to rebound and move forward and is up 2.8%. As you can see in my comments here, there's been a lot of volatility in the equity markets. Even though we are up considerably for this year, we did see a drop off, a sell off at the end of August there coming into this September, but the markets seem to have recovered pretty darn well moving into the second week and into the middle of the month. The Fed has this week cut rates a half of a point. This is the first time this has happened in a long time. I'm going to touch on that in a minute here. It came in a little higher than some of the expectations. It was expected somewhere between 1/4% and 0.5%. They did the 0.5%, so it was at the higher end. And as I pointed out, bonds are continuing to rally as a result of the anticipated interest rate cuts, and they are up 1.8% so far in this September. When we look at some of the sectors within the S&P, you can see here that technology still is kind of leading the pack. Year-to-date return at the top is showing a little lower than what I just showed you because the market is actually up in September. This is the end of August numbers, but it just kind of gives you a feel where the returns are coming from. So technology is leading the pack. Most of the broader market, as you can see through the different sectors, has recovered and is moving forward with double-digit returns this year. However, a few are lagging, and the biggest still is energy. We have not seen huge increases at the pump, but real estate has recovered. A lot of good things going on as this broader market rally continues through September of this year. A lot of people were concerned at the end of August. We had a pretty sizable sell-off, about 8%. Basically, it was at the same time that we had that cyber attack that impacted a lot of companies that used CyberStrike for their security, including the airlines. I know people got stuck traveling because the airlines scheduling systems were all down and so on and so forth. Here's the top reasons basically behind the market pullback. The economic growth into next year. They're concerned as the economy is slowing, is it going to be able to sustain solid growth into next year? The tech company prices of their stocks is at all-time highs relative to their earnings. So there's a concern there. The yen carry trade, that would take a little while to explain. You can look it up, but it's basically hedge funds and other investors borrow money in yen and convert it to buying instruments in the United States, money market CDs, stocks, bonds, things like that. Well, Japan raised interest rates, which caused those hedge fund companies to sell off, which was part of why this market dropped. It seems like all those things came together at one time and caused that sell-off. However, remember I said the market has pretty much recovered that here by the middle of September. As we talked about a couple slides ago, the Fed has reduced their funds rate from 5.5 down to about 5 at the upper limit. When you look at this chart, you can see way back in 4 years ago where interest rates were at in the low 2% range, the Fed funds rate. It went to 0 because of COVID. We had to fight our way out of the economy shutting down. But then inflation came in, and you can see how fast the Fed ratcheted up their funds rates all the way up to 5.5%. We finally are starting to see some relief there, and I think that's going to bode well for the markets, including the bond, the stock and bond markets both moving forward, kind of creating more of a normalized stock bond mixed portfolio return that we are accustomed to in the past.